Hello, this is Rich Siegel with ARQ Wealth Advisors. It is 6:30 on March 19th. Hope everyone's doing well. I wanted to reach out this evening and give an update on the markets and some perspective. I know these are very trying and unsettling times for everybody, myself included. We've seen tremendous volatility in the markets on a daily basis, and we're not used to it. This is unusual. This reminds me of the credit crisis that happened during the Great Recession about 11 years ago. We're seeing moves on a daily basis of 3, 5, 8, 12%. Typically, moves are typically 0.5% to 2%. So these are definitely unusual times. The VIX, the measure of the volatility, implied volatility, the fear indicator, typically trades in the 18 range. Today it's still in the 70s. And I believe we hit as high as 85, which is actually higher than the credit crisis record of, I think, 82. So fear and panic is out there, and that's why the market is coming down so fast. The market is a forward-looking mechanism. It's pricing in the worst-case scenario, which would be a recession, mass layoffs, and a spreading of this pandemic. This is called a black swan event. No one knew it was going to happen. You really can't prepare for it in advance. It happened, and now we're in the middle of it. Now, if you're a long-term investor, you're fine. You will get through this, whether it's 2 months or 8 months or 2 years. But while it's happening, it's very disheartening, it's very scary, and it's very upsetting. Okay? So let me give you some numbers. This here is a chart of year-to-date returns, this top chart here, of the U.S. stock market indexes. Let's take three. The first one is the S&P 500, down 25.5%, basically in 2.5 months. The second one is the Dow Jones, about 30%. And then finally, small cap stocks, the Russell 2000, down over 40%. This is serious carnage here. The second chart would be foreign markets. The first line, the green, is developed markets. That would be Europe, Japan, and Australia primarily. Excuse me. And then the emerging markets, the blue line, pretty much in line with the Dow, actually. China, India, Brazil, Russia. Over here, more interestingly, I think, is the fixed income or the bond markets. Bonds are in the portfolio for stability, for income, and to hedge equity markets. That was happening all the way up till about a week and a half ago. And this reminds me like the credit crisis, where everything was correlated together. Investors were throwing the baby out with the bathwater. The bottom line is this. Bonds are issued at $1,000 par, and they mature at $1,000 par. So if bonds are getting hammered like they are here, unless they default, the money will be paid back, and the prices will go back up. That's just the math of it. The green here is the aggregate index, which is the highest quality bonds. This would be treasuries, mortgage-backed securities like Ginnie Mae's, and then the highest quality corporate debt. From peak to trough here, it's down about 6% in a week and a half. Highly unusual. The blue is municipal bonds. The orange would be investment-grade corporate debt. That's a lot of corporations issuing debt to fund their operations. Corporate debt typically has higher yields, and corporations up till now were flush with cash, and the ability to pay back their debt was extremely high. Over here is the junk bond market, down about 15%. So you can see here, there's been a pretty decent collapse of the fixed income markets as well. Okay. Same thing happened in 08 and 09, by the way. Now, for perspective, you are allocated. You're in an asset allocation model based on modern portfolio theory, which has been time tested for the last several decades. Things come back. It doesn't feel like it when you're in the middle of it, but things will come back. This is a picture here of the bottom. This is March 9th of 09 through the end of that year. So 10 months, essentially. When things came back, they came roaring back. The Russell 2000 was up 80%. The Dow Jones was up 61%, and the S&P up 66% in 10 months. Foreign markets did better. Emerging up 106%, developed markets up 75%. Finally, bonds fixed themselves. The price discovery worked, and we had the highest quality up the least, up 6.9. The municipal market up 7, up 9 for munis, 21 for investment grade, and 59% for the high yield market. So when this does come back, it's important to stay invested because you don't want to miss out on any of this. If you miss out on part of it, that's okay, but we want to get most of it. Longer term perspective, I want to focus on something called regression to the mean. It's a concept in investing, meaning that over the long run, things tend to average the same numbers. So for 25 years, 50 years, 100 years, the stock market tends to kick out returns in the 9% range, bonds in the 4 to 5% range. Let's focus on stocks. This is a 3-year chart right here of the S&P, which is now up on average 2.2%. The Dow is up 0.69%, and the Russell 2000 small caps have an average return for 3 years of negative 9%. Consequently, today, the S&P was up 0.5%, and the Russell was up 6%. So they kind of take turns leading and following. There's a lot of volatility in the markets. Here's a 5-year chart. 4.8 for the S&P, 4.4 for the Dow, and then negative 3% for the Russell. Okay, so what I'm saying is here, over the last 3 and 5 years, high quality returns have been wiped out because of this last month. Here's a 25-year chart. Now keep this in mind. Over the last 25 years, we've been through 3 major crises, right? The first was the tech bubble. Okay, huge boom, long bust. Recovery, credit crisis. Recovery, here we are over here now. This is not to scale, but you can see how over time, if you left your money in these markets for the last 25 years, including today in this latest 1-month drawdown, you're up 768% in the Dow, 682% in the S&P, and 440% in the Russell 2000. Okay, so this will come back. We will get through this together. If you have an immediate cash need and you're relying on your portfolio to meet that need, we have some cash available on the sidelines in your portfolio. If you have concerns, questions, fears, please reach out to us. That's what we're here for. In the meantime, please stay grounded. Please stay healthy and calm. And we'll speak to you soon. Have a nice evening.